All right, that's our MPC decision quoted by the RBI governor. No change in repo rate. You know that. Neutral stance. No change there. CRR cut by 50 basis points. That's the big thing, and a lot of other detail around inflation, etc. And we'll get into the minutiae, but let's get in our guests to try and understand what do they make of these announcements. Aditi Nayar, Chief Economist, ICRA; Jayesh Mehta, Vice Chairman and CEO at DSP Finance; Katrina L, Director of Economic Research at Moody's Analytics. All three with us. Thanks so much, all of you, for joining in. Jayesh, I'll start off with you. Anything caught by surprise? I thought the change in stance probably the only outlier. Otherwise, you could argue that it is on expected lines. The optimists may have hoped for a repo rate cut. It hasn't come.
Yeah, that's absolutely on expected lines. So some people were expecting a repo rate cut to be only 0.25%, but normally we have seen in past also they may move by 0.5%, which gives off kind of 1.116 lakh crores, 1 lakh crore plus liquidity situation. So I think that was required, and that's a start. And with this, it kind of cements the view for February rate cut, because if you look at the inflation projection for the balance 3 quarters after that, is at much lower rate. Like Q4 is almost 4.5, 4.6, Q1 next year, and 4% Q2 next year. So from that perspective, kind of affirms February cut, and that was what market was expecting. So good, actually.
Well, Aditi, good morning. What did you make of the policy decision? No change in stance, no rate cut, but a CRR cut to ease liquidity in the system. And surprisingly, no mention of the global or foreign shocks that we may have to face.
Actually, quite interesting. We were not expecting any change in the repo rate or in the stance, and we were also not really expecting a CRR cut to come in right away. So that's a positive surprise that we got in today's policy. And while there was a lot of talk of patience and prudence and practicality and timing, I think which is completely warranted by the fact that currently the headline inflation is above the MPC's upper threshold of 6%, which is what really ruled out a rate cut in this policy. Now that we've got the CRR cut, I think that's a very strong signal that if the CPI inflation does moderate in line with what the MPC is expecting, then a Feb rate cut would definitely be on the table. So our own view is that we're going to see a good amount of retracement in the CPI inflation, so 550 in November and hopefully around 5% or a little below that in the December print. And if there are no other negative surprises that emerge and the trajectory for inflation that's been outlined today remains intact, then I think that will really set the stage for February rate cut.
Okay, Katrina, your initial assessment, there seemed to be this, not too much of a reference to global pulls and pressures, if you will, a lot of local factors, a lot of emphasis on inflation as well. 4% mark only reached in Q2 of FY26 with risks evenly balanced. What did you make of it all?
So I thought it was to be expected that we didn't actually see a rate cut from the RBI this time around. I think when you've got an October inflation print that surprises on the upside and comes in at 6.2%, which is at that breaching the upper threshold of the RBI's bands, then they're not really going to want to be cutting rates in that sort of environment. And I thought it was really interesting how it was very clear how delivering sustained moderation in inflation is really the priority, perhaps even more so over the fact that we did see moderating GDP growth. And it was interesting as well to see that they're highlighting, at quite length how negative a sustained inflation environment can actually be in terms of eroding purchasing power for both households and businesses. And so it is really their priority to get inflation sustainably back to that target range. And so with these upward revisions to inflation over the 25 financial year, even though they are modest, I think that does, is quite telling to the fact that the RBI is going to tread incredibly incredibly carefully when it comes to the timing of their rate cut, and it won't take much for them to continue to push that out. So with that in mind, our expectation is that we will see a cut being held off until around Q2 of next year. So looking around the April-May type kind of timing at this point.
Jayesh, my next question is a bit of a conundrum that Neeraj and me were talking about. You have the Fed meet in 10 days from now. If the Fed doesn't cut, will the RBI still have the ability to cut in Feb? And the reason I ask you this is because rate differential is important. Even though the governor chooses not to talk about it, it has a direct impact on flows, which then directly impact the currency and the setup on the bond and the equity market.
I think, earlier rate differential really didn't matter for us much because we were not really having debt FPI investment. Now with inclusion in JP Morgan Index, it will have some impact, but it is still very, very limited, right? I think in India, we have always seen, of course, regulators think differently, but we have always seen, higher rates, therefore, equity outflow and therefore not good for currency because that's where most of the, unlike most of the countries, we have more equity inflow outflow to tackle rather than debt inflow outflow. But having said that, I think with growth kind of staggering down, or maybe, even the forecast went down, keeping this real rate so high, if your inflation target in February policy will come down to below 4.5 almost, if you look at the Q4, Q3, Q1 next year and Q2, there is no reason even if you are 4.5, 4.25 to keep 6.5 repo rate. The real rate being so high can really, really damage the growth. And therefore, irrespective of what US does, we will have to look at that.
Mm-hmm. Okay. Now, Aditi, the word around inflation seemed to be the key driving point because, like I said, when I looked at the numbers given out by the Reserve Bank of India, 4% inflation only coming at Q2 FY26 in a scenario when that is the inflation expectation, and if indeed the Fed were to be hiking rates, even if growth were to not quite pick up in Q3, do you think the RBI just refrains from any kind of rate action because of those factors?
Look, I think primarily the RBI has always made it clear that they're looking at the domestic growth inflation balance, and even in the last few policies, while the Fed has been cutting, it has been the domestic trends which have taken center stage as compared to what the Fed has been doing. And overall, I still maintain that the Fed is going to, in the entire cycle, end up cutting a lot more than what the RBI will have the space to do. We are only looking at 50 basis points in this rate cut cycle coming in from the MPC. Our baseline expectation at this point in time is that the 2 cuts will come in February and April. If we end up with a negative surprise on inflation, certainly that is something that could push the timing out to April and June, for instance. But I don't think we're going to be doing a one-to-one correlation with what the Fed is doing. The Fed has already cut and we haven't done anything. So if the domestic situation allows it, I think the rate action will come.
Katrina, do you feel like a CRR cut for now would be enough to help growth come back on track? The GDP shocker didn't go down to 12 at this rate, and I'm assuming a piecemeal approach at this stage may not do much either.
Yeah, it's an interesting conundrum, I think. I think that the RBI is, trying to manage lots of different forces in the economy with, several different policy levers. So I think that the CIR reduction does certainly help, but it's not going to, reinvigorate growth to a 6% type level at this stage. But it is certainly going to help in terms of the liquidity and those, lower income households or, smaller businesses that are more struggling with, credit lines. I think they will get a little bit of relief, but it's certainly not going to be a game changer at this point. And I think the RBI is incredibly aware of that. They don't want to, completely reinvigorate domestic demand when they do have an inflationary problem. And sure, that inflationary problem might be driven by domestic supply side factors, particularly around food prices, especially vegetable prices. But they need to be cognizant that even though that might be the case, if they were to inject too much to, really lift domestic demand, then that would be problematic. And then, of course, that's going to then further push out the timing of when the RBI can actually reduce rates. Because if we know that they're favouring inflation and really prioritising that, then lifting domestic demand too aggressively through these CRR cuts isn't going to help the timing of cuts, and it's certainly not going to bring them forward. It's only going to push them out further.
The follow-up to that, Katrina, though, is this, that the governor did mention that Q2 growth has bottomed out, Q3 there are signs of pickup. No one knows the extent of the pickup, but is the presumption that liquidity management in a case of government capex picking up and growth showing up in Q4 is probably the only thing needed to do right now? Wait and watch what the Fed does, what the inflation print plays out, and then take a decisive action only in February. Because, like I said, the one surprise to some people, I know Aditi didn't say that, but for a lot of people, the stance change was almost a given, and that hasn't happened.
Yeah, it's interesting, right? And there's so many uncertainties. I mean, not just when it comes to Indian domestic data, but also in terms of how the global economy is going to perform. And if we, bring in the recent US election results, we know that President-elect Trump, for instance, has proposed some sweeping changes in terms of global trade from a US perspective, of course. And so if we do see, reductions or, rather increases in terms of tariffs on exports, or if we do see immigration reductions of Indian arrivals into the US, and that could of course have consumption impacts. So there's a whole lot of uncertainty at the moment, and I think that the RBI is really just trying to manage that and try and keep inflation as its priority. They can control that, and also trying to manage the domestic kind of growth uncertainty. So certainly it does make sense to tread really carefully at this point.
Aditi, I know we are all talking about a neutral, accommodative stance by the RBI, but the fact remains the Trump card is Trump, right? Because if he talks about tariffs, he talks about everything that he's going to do. On one hand, India central bank may be okay with a depreciating rupee because that gives us a competitive advantage over China. But on the other hand, if we do follow the mother market and the Fed pauses, is there a small outside chance that maybe we go into a setup where we don't actually get a rate cut? We may even look at be staring at a rate hike in the next 6 to 8 months, because that uncertainty is fairly important.
If we have a situation where all of the global factors that you're talking about lead to a sustained increase in inflation, I think only in a scenario like that could we come in for a rate hike. I don't see any other scenario building up for a rate hike right now. If anything, the Trump tariff threats would only reduce our growth further, depending on when they're imposed and how widespread they are. That's certainly not going to set up the case for a rate hike. It will be the inflation impact that could do that, and I'm not seeing a large possibility of that right now. On growth itself, our view is that the Q2 5.4% was a bottom. That quarter was an aberration in some ways because there were some sectors that were completely doused by the heavy rainfall, and that's a temporary factor that has gone away. The high frequency data for Q3 is looking a lot better, whether it's the auto sector or some improvement in the coal sector, electricity, etc. The typical high frequencies that we track. And the scope for government capex is of course very high in the second half of the year. We do expect that there will be a shortfall. The government is unlikely to be able to meet the budget estimate for capex. However, the YOY growth in Q3 and Q4 would still end up being quite high, which will provide a boost to domestic growth. And also, the rural economy should see a more sustained sentiment now. after the Kharif output, with reservoir levels being better. The last round of data that I saw for the Rabi sowing had also improved, and generally the stage is set for a more sustained rural sentiment as compared to what we had seen in the previous year. So that would also be a positive. However, my sense is urban consumption will remain uneven, and we have periods where our urban consumption does better but rural doesn't, and then vice versa. My sense is that urban and rural consumption are not necessarily, they're not substitutes for each other. They drive very different sectors. And secondly, the tax impact of which part of the consumer economy is booming can be quite different. Urban consumption being on an uptick would be more tax positive, would probably generate more tax revenues than rural consumption. So obviously there are differences in revenue implications of where consumerism is booming in the economy. But generally I am also constructive for H2 from a domestic standpoint. And our GDP growth forecast for FY25 is 6.5%, so just a tad lower than what the governor revealed this morning.
Jayesh, very lastly to you, and you're probably the best person to talk to about what's happening in the bond and the currency market. Forex reserves have declined for the last 8 weeks. We've been touted as one of the safest or least volatile currencies since the pandemic, right? So rather stable. Do you feel like an increase in the interest on FCNRBs, maybe a CRR cut for now, could be enough to protect the downfall on the local currency? And how significant is maintaining forex reserves at this time, at this juncture?
So, of course, as Governor always used to say, right, we have an umbrella to use in rainy season, right? But the way the global trends are going in, your umbrella will still make you wet, and that's where you feel you will depreciate, which is what is reflecting today. Is 84.61. We touched 84.70. I don't think this thing can rein in so much, but hopefully FBI equity outflow, if it's, I'm not saying that we get an equity inflow, even if it stops going outflow, we should be okay on our currency. I think it's right now the momentum, and it's also the NDF market, which is also driving it with all other PM currency. So there is a point up to what you can support that or resist that. So it's more about the global situation rather than domestic situation for currency to depreciate.
Mehta, emerging market bonds funds have seen outflows the last 2 consecutive months. But thank you Aditi, thank you Jayesh, and thank you Katrina. Have a good day and a great weekend. We'll speak to you all soon. Well, that was of course policy action, largely Neeraj in line.